Good evening, everyone. Today I've just created a report on the topic, a comprehensive analytical report on Sensex and Nifty projections 2025 to 2035, the present 10 years I've just taken, future 10 years. So, the content of my report is the introduction, the macroeconomic backbone of the market growth. The second point is that why Sensex and Nifty will continue long term growth. The third point is that the methodology of projection. The fourth point is that the Sensex projection of 2025 to 2035, Nifty 50 2025 to 35 projection. Evidence of this projection I also put it in my video and also in my presentation. The sectorial growth drivers, the risk analysis, and the Indian's valuation versus global market, investment strategic code, investment strategy, aggressive growth, and also the SIP strategies, which I have been put in my video and also in my presentation as well. The evidence supporting the long term investing, the portfolio backtesting, historical simulations, real time testimonial style statements for the report. I have also done a modern portfolio for 2025 2035, key insights and forecast summary I have put in over there, and also I've just put in a conclusion at the end that what is going to be seen from the above report. So let's not waste time. Let's jump into the introduction where I've just said about the GDP growth pattern, where we are understanding the long term economic trend impacting equity markets. Debt to GDP insights analyze of the financial health and its implication on the market investment. Number three is the demographic projection evaluating the labor force and consumption potential. Transport infrastructure correlation to economic expansion, where I've just explained the exploring the link between infrastructure investments and economic growth. Macroeconomic backbone of market growth. India's GDP growth historically averages 6 to 7% for longer period, establishing a consistent growth trajectory that supports investments. India's demographic dividend continues until 2050, I repeat, until 2050, a favorable labor market boosting consumption. And the third is the infrastructure acceleration boost economic valuation, investment in transport and logistic correlation directly with economic growth. Then the third statement why I have said that why Sensex and Nifty will continue long term growth. So to support my statement, I have just raised five evidence points where I have just explained in short lines that why it will continue the long term growth Sensex, or else you can say of Nifty as well. So, rising economic levels, increasing disposable income enhances market potential. Number two, consumption led economy, growth driven by domestic consumption. Number three, the global manufacturing shift to India, India's evolving role in the global supply chain. Number four, the FPI's inflows and domestic SIP inflows hitting record highs, strong indicators of market confidence, evidence for GDP correlation, higher GDP equal to higher corporate earning, higher index valuation. The methodology which is being used of in the projection is that historical CGR of Sensex 14.2% over 40 years, expected GDP CGR 7 to 8% from evidence provided, EPS growth trend understanding earning per share trend for better forecasting, and then last the valuation normalization circle adjusting for market cycles. Sensex projection for 2025 to 35. For the year 2025, the conservative case will be of 78,000. The index will run over the, in the base case is of 80,000, and in a bull case it is 83,000. For respected of 2030, it will rise in the conservative 1,20,000 in the index range, and in the base case it will be 1,40,000, and in the bull case it will be 1,70,000. And for the year 2035, 1,85,000 for the conservative. For the bull case it will be 2,40,000, and in the base case, and in the bull case it will cross 3 lakh plus. Reasoning: GDP growth, manufacturing boost, tech expansion, and the formalization of economy, which is UPI led. So Nifty 50 projection for 2025 2035. 2025 for the conservative it will be 23,000, for the base case 24,200, and for the bull case it will be 25,000. For 2030 it will be 36,000 for projection of conservative. For the base case it will be 41, for the bull case it will be 50,000. For 2035 it will be 25,000 for conservatives. For base case it will be 70,000, and for bull case it will be 90,000 respectively. Why Nifty is stable than Sensex? For the broader sectorial diversification, more sectors make up the index, stronger representation of new age industries reflecting the current economic trend. The evidence for this projection is that the report outline has several economic findings, where I've said that high GDP growth is equivalent to high transport, logistics, and private consumption, boosting corporate earning. For the second, low debt risk despite high debt to GDP due to domestic borrowing strength. And number third is the demographic creates sustained demand until 2050. And for the last is the technological plus infrastructural improvements double GDP growth rates. For the sectorial growth drivers behind index rise is the high impact sectors include banking and MBFCs, the leading and financial services growth. Number second is the manufacturing PLI schemes, the policies aimed at boosting productions and global competitiveness. FNCG and consumption is the increased household expenditure is the driving growth is for third. And for fourth, EV and renewable energy is for fourth is the rising demand for sustainable energy resolution. And for fifth, IT plus AI plus digital infrastructure growth in technology sector supports overall investment. The risk analysis is that the major threats include number one, geopolitical disruptions, the global uncertainties impacting market. Number two, high crude oil prices, inflammatory pressures from energy cost. Number three, overvaluation cycles, risk associated with market excitations. Number four, policy shift, the changes in governance impacting business climates. Number five is the global recession risk, economic downturns affecting investment. The conclusion is that long-term investors will benefit due to economic cycle recovery. So number 10, India's valuation versus global market. The high growth potential, India is expected to outperform many markets. The strong corporate governance, confidence in the business environment, and in the third, we have the deep retail participation, high level of consumer engagement in the market, and in the third, we have the structural reforms like the GST, IBFC, digital payment, enhancing market efficiency. Premium valuations are sustainable for young, high growth economies. Investment strategy for core. Strategy 1, core portfolio, long-term wealth creation. 40% Nifty 50 index fund. Second, the 20% for Sensex or Nifty 50 next. 20% is for the mid cap index, 10% for gold ETF, 10% for gold global ETFs. The rational diversification The investment strategy for aggressive growth is the second strategy, where the high growth portfolios, where the 35% will be mid cap, 20% will be small cap, 20% will be nifty, 10% will be IT or AI funds, 10% will be manufacturing, infra, and 5% will be PSU banking. They fit India's growth infrastructure correlation. So the 13 SIP based strategy, expected return 12 to 14%, SIP needed 25 to 28,000 a month. Why SIP? Market timing, eliminating volatility benefits through rupee cost averaging. Evidence for supporting long-term investments. Your research demonstrates several points. Infrastructural expansion always boosts GDP growth. High GDP lead to higher mobility, consumption and logistic demand. Uh, Corporate earning rise, sustainability outperforming other assets classes long term. The portfolio backtesting historical simulation. If investing rupees 10,000 a month if in Nifty since 2000, then the total investment will be 30 lakh and the current value is 2.6 crores, which shows the compounding impact when GDP grows consistently. Real testimonial style statements for report. India's demographic engine and digital transformation make it one of the world's most reliable long-term investment destinations for global fund managers. Equity markets in India reflect structural economic strength, not speculation of senior economists. Number third, the Sensex and Nifty will continue compounding because corporate earnings grow with GDP market analysts. The model portfolio for 2025 to 35 is that 35% in Nifty 50. Nifty next 50 is 15%, mid cap index 20%, flexi cap fund 10%, gold ETF 10%, international tech ETF is that 10%. The key insight, the key insight and forecast summary. The Sensex 2035 target is that 2,40,000 to 3 lakh, and Nifty 35 target is 70,000 to 90,000. For India's GDP remains one of the fastest growing globally. Rising income levels and consumption expansion, young working population until 2050, UN evidence, digital plus infrastructure revolution. Okay. And in the conclusion, I must say that India is entering a multi decade economic expansion cycle strongly supported by structural fundamental. Stock markets mirror its growth through higher corporate earning, innovation, and deeper financial inclusion. A disciplined investment framework can multiply wealth over 5 to 10% over the next decade. Thank you.